Well, the trend with results out of South African banks has been a reflection of, the sport in earnings coming through from a decrease in bad debt write-downs as opposed to from advances growth. And that's typically what drives revenues for a business. In Standard Bank's case, though, credit impairments reducing 13%. We've got loans and advances up 50%. So it seems like you're making pretty good progress on both fronts here.
Yeah, we definitely are. Our loans to customers, if you look at the entire growth in loans to customers, was up about 13%, which we think is a pretty good result. Obviously, it's helped by the fact that we're not just restricted to South Africa, that we have an African franchise. We have had the benefit of the bad debt ratio kind of coming down by almost a half from its peak. But, you've also had a slightly lower endowment effect and so on. So there have been some headwinds as well. But for us, the big issue was keeping costs flat, actually, which we undertook to do a year ago.
Of course, costs flat year on year. We've got that cost to income ratio sitting at 58.8%. Let's take a look at prospects moving forward, because while you've got that focus on costs, I mean, it has affected headcount in a big way. Is this a case of looking now at Standard Bank as a leaner, meaner operating machine, or one that's running pretty close to the bone?
No, we definitely took, as I think was well publicized, we took very tough action a year ago, and we don't have to do any of that anymore because we did it then. Having said that, there always will be pockets of business where you either scaling down. We are still continuing to scale back our London banking operation slightly. So that, there are pockets, but generally I'd say everything that we've done has been done. And we now outwardly focused, trying to look for business opportunities rather than focus on cost cutting. But of course, in a low growth environment, you have to be very mindful of your costs and your growth in costs.
Okay, let's take a look at just how much of a challenge that's going to be, because you're certainly not resting on your laurels. I mean, you're not investing heavily moving forward. Yes, you've wound down your international operations. You've got operations, though, in at least 17 sub-Saharan African countries, while your engine is here in South Africa. What growth strategy exactly are you pursuing on the African continent?
Well, for us, Africa is at our core, and that includes South Africa, which is the mothership. But what's going on in Africa and the links that we have with China to Africa are very important. We had some positive results. The earnings from our African banks, the on-the-ground banks in Africa, were up by 38%. So I think that was a good outcome. We actually also saw cost growth in our rest of Africa operations of about 10%. So despite keeping costs flat across the group, we still invested and grew the costs in the African businesses by 10%. So for us, that does provide a strong future growth lever.
What progress are you making, to drive other income lines? If you're talking about future growth levers here, I mean, net interest income up 7%, but in a scenario where specifically in South Africa, you've got rates looking to stay lower for longer, and you've got it being harder to push through rises in fees and commissions, for example, you've got to be directing attention to growing other revenue lines.
Yeah, Standard Bank, fortunately, is well spread. We don't rely just on earning fees and commissions from personal customers. We have a strong business banking franchise, a strong corporate banking franchise, a strong advisory franchise. We were recently, in Dealmakers Awards, nominated as leading mergers and acquisitions franchise in South Africa. So we have many of these businesses which are not charging fees, but do generate they do generate revenue for us. And of course, we have a strong trading business, trading foreign exchange and the like, and not just in South Africa, in all the countries in which we operate. So for us, we have multiple revenue streams, and we actually saw growth in fees and commissions in this last year of around 11%, which was ahead of the 7% growth in interest income that you mentioned.
Yeah, it also places emphasis on the kind of relationship that you're developing with Mizuho Financial Group on bringing more Japanese clients towards Africa. So take us through that relationship and what you envisage for that moving forward.
Well, we try so hard because we have a platform that spans multiple countries to find linkages to other key markets that are interested in Africa. That is what took us originally to Russia, what took us to Brazil, what took us to China. Now, I think we all know that Japan has had for many, many years had strong linkages into Africa. Their big trading companies have had strong linkages into Africa. And so for us, it is just yet another way of making sure that we benefit or can find a way of accessing customers in Japan that want to do some kind of business, whether it's trade finance or foreign direct investment. And that is why we decided to form that strategic relationship.
So while that's one strategic relationship that you're pursuing, when it comes to the rest of your expansion strategy, the focus seems to be on organic growth more than anything else. At what point does acquisitive growth become interesting?
We would always be interested in acquiring banks on the African continent. We wouldn't be looking to buy a bank in some other market given our tightened strategy. That's why we're looking more to link to other markets through partnerships and strategic relationships. But on the African continent, we are always on the lookout for acquisitions. But if we're realistic at the moment, it would appear to us that we are more likely to be invest in building branches, investing in IT systems, expanding our networks rather than acquiring. But if there was a good acquisition in a number of the key markets at the right price, we would jump at it. I think we're just flagging that we think that seems unlikely. There's nothing on the horizon at the moment.
While you've come to that realization on that front, you've also recognized that your current ROE sitting at 14.3% is pretty low. What are you doing to, or going to be doing to actually improve that ratio? Because it is going to be a tough feat, Jacko, in a context where you're looking to expand so aggressively.
We are in a very fortunate position that our capital ratios are strong, and we are getting some capital in. We announced recently that our Russian transaction had concluded and the money came in January. We're hoping that our sale of our bank to ICBC in Argentina will come in. So we'll be sitting on capital, and clearly for us, we can use that capital to productively increase our earnings, and that would be our hope. Of course, there are lots of levers to improve the return on equity. We're actually paying a lower dividend cover, so there's decent dividend growth coming through. All of these things will have an impact, but finally, it is about earning higher profits in our corporate and investment banking business. That's where the main drag at the moment is. But the business is doing well, but we've got a lot of hard work still there over the next couple of years. But we actually see it as an opportunity rather than a problem.
Well, best of luck to you, Jacko Maree, CEO of Standard Bank, joining us this afternoon and just unpacking the company's results released this morning.